Now we know what the budget means for all of us, and it'll be interesting to see if Rachel Reeves's first attempt to balance fiscal probity with investing for growth has any effect upon corporate and consumer confidence when we see the next readings from the Purchasing Managers Indices and also the consultant's GfK next month. Consumer confidence should be particularly interesting, since the GfK survey dipped in September and again in the reading revealed on the 25th of October. Now, this feels a little bit at odds with the so-called misery index, a measure coined by the economist Arthur Ocon. It adds together the prevailing rates of inflation and unemployment, two sources of potential misery. Based upon the last month for which we have both readings, which is I think July, the misery index is just 6.2, 2.2% inflation added to 4% unemployment, and inflation has retreated to 1.7% since then. So that score of 6.2, well, it's below the post-2000 average of 8, and is well up from the peak of 14.9 reached in autumn 2022, which just happened to coincide with the Trussonomics debacle. Why consumers are therefore not feeling more confident is a bit of a conundrum for politicians and central bankers alike, not to mention retailers, although the FTSE All-Share Retailers Index trades at fairly close to its peaks of early 2022. In this respect, the stock market seems to think that better times lie ahead, and in the coming weeks, retailers with different target markets will provide some insight into how accurate that viewpoint may be. They are Primark, owner Associated British Foods on Tuesday the 5th of November, food, clothing and homeware bellwether Marks & Spencer's on the 6th, and grocery giant Sainsbury on Thursday the 7th. AB Food shares have actually retreated from May's 6-year high, not helped by a mixed trading update back in September, when the main disappointments were profits at Sugar and like-for-like sales at Primark. All 5 business units did show increased profits at the first half stage and are expected to do so again for the full year, but AB Foods has already pointed to a steep drop in sugar profits for fiscal 2025. Watch also for comments on the trend in Primark's like-for-like sales and the fast fashion brand's profit margin, which is expected to come in a little above 11.5% for the year just ended. The trends here, and agriculture, grocery, and ingredients will all shape their headline earnings per share or EPS figure. A big jump for the year to September 2024 is already expected, and of greater interest may be any guidance for the year to September 2025, for which consensus is expecting a small drop to 182 pence a share from 187 pence on the basis of stated and not adjusted earnings per share. Watch out also for the dividend after last year's special and the 46% increase in this year's interim payment, as well as the share buyback. AB Foods has completed a £500 million programme and already launched a £100 million follow-up scheme. Meanwhile, shares in Marks & Spencer trade at an 8-year high, even though the company has said precisely nothing since its upbeat full-year results back in May. These first-half figures should therefore be particularly illuminating, as should an analyst meeting slated for the 12th of November, where like-for-like sales trends, margins in clothing, earnings at the food delivery joint venture with Ocado, and commentary on overseas opportunities are likely to be hot topics. Before then, shareholders will look to Chief Executive Stuart Machin for commentary on all of those numbers and also any guidance for full-year figures. For the first half, total sales are expected to be £6.6 billion, up more than 7% from a year ago, and that's also the growth rate anticipated by analysts for the full year. Remember to check out the like-for-like sales growth rates in food and also clothing and home, where the former should be strong and the latter still in positive territory after a long period in the doldrums. First half pre-tax profit, well, that's expected to be £327 million on a stated basis, actually a bit down from last year, as the company invests in pricing, new stores, refurbished stores and supply chain and logistics, even as it seeks cost efficiencies. For the full year, analysts are forecasting a 10% increase in full-year pre-tax profit to £760 million. M&S is also expected to pay an interim dividend, 2p a share, up from a penny a year ago, when the company returned to the dividend list after a 4-year hiatus. Finally, we come to Sainsbury, whose share price is no higher than it was 20 years ago, even after a solid gain of some 10% in the past 12 months, as the firm remains locked in a dogfight for market share with Tesco, Morrison, Asda, and the discounters Aldi and Lidl. Sainsbury's been more than holding its own here and has actually taken share over the past 12 months, according to consultants Kantar, as could be seen also in July's first quarter trading statement, when grocery sales rose 4.8% and total retail sales rose by 2.6% excluding fuel, and on a like-for-like basis. Now, these trends will be one key feature of the first half results, where analysts forecast total sales to reach £17.5 billion against £17 billion a year ago. After that, attention will switch to retail operating profit and cash flow, where Chief Executive Simon Roberts has guided to 5 to 10% growth in the former to just over £1 billion, and for at least £500 million of the latter. In the first half of last year, Sainsbury's achieved underlying retail operating profit of £485 million, with £13 million from the bank on top. Any update on the sale of the bank to NatWest will be welcome, and the final point of note will be cash returns. Sainsbury's is running a £200 million share buyback and is expected to increase its full-year dividend to 13.5p a share from 13.1p a year ago. Last year's interim payment was 3.9p a share. Thank you for watching. I hope that you and your families are all keeping well, and I look forward to seeing you again next time.